name's Rich Knuppe. I work with Farm Credit. Been doing livestock risk protection for the last 4 or 5 years. Obviously, I'll show a slide here later that just shows how much LRP has grown. And quite frankly, do we have any guys that do fat cattle in here? Probably not. Don't assume there's a lot of feed base out here. So we'll focus on feeder cattle because really that's what LRP works really, really well on. I'll start you off with a joke. There's this rancher. It's coming out of freeze. April. He's going to go out and start fixing fence. He's sitting there digging his post hole, and he gets to the bottom, and it ding, hits something. Pulls out his genie in a bottle. So he rubs the bottle. Genie comes out. Gives you got 3 wishes there. He says, all right, well, moisture. Like we've been through droughts in this area. It's Wyoming. Like if we can have good moisture all through the year, timely rains, timely snows, all that jazz, like that makes me a happy guy. He says, boom, we'll have all perfect moisture for the whole year. Second wish, he says, boy, if I got good moisture, if I can get good prices, I'm due for some good prices here. He says, I guarantee you I'll give you the best markets you've ever had. He goes, if I got good moisture and good markets, I'll just hang on to that third wish. I'll keep it in my back pocket. So it gets around to August, September, and he rubs on the genie, comes out there, he says, all right, what's going to be your third wish? He goes, well, boy, I just really take some good prices. He goes, well, I thought I already gave you the best markets you ever had. He said, yeah, but this time I'm going to take it. And that is where we're at right now. LRP, like right now today, the one thing you can take from this is, we mostly cow-calf guys, or we got yearling guys in here. Mostly cow-calf will say. Wait, for next fall, I can, once I take the premium out, I can still guarantee you the highest priced calves you've ever sold. So it's not like I'm some super salesman, it's like we've got really good prices that we can work with right now. And so everybody should be, if they haven't already, ought to be looking at locking in some 2024 calves. Kind of like Nikki said here in the presentation before, I talk about LRP a lot. I love LRP, so if you've got any questions while we're going here, just interject. It works a little better if we go back and forth until we get to the end and then all the questions come up at once. But basically the way this works is I get to use the Chicago Board of Trade. Say the board closes at 3 o'clock, I can generally get 99 to 100% of what that board price is. And then say we do it for next October. So we set that price for next October, then next October comes around and we settle using what's called the feeder cattle index. The feeder cattle index takes any animal any steer animal between 700 pounds and 900 pounds in the Midwest basically. So from Texas on up to North Dakota, and they take the total dollars they sold for divided by the total weight. And so why that's good for us is we get rid of basis risk on there because it's actual cash prices. You're not dealing with speculators on the board or having a poor basis. It's actually what the cash market is doing. And quite frankly, when I first got into LRP, once I believed in that, it's the game changer for the entire product on there. I do like to point out that we're essentially insuring the market, not necessarily your cattle. And so if you've got the best cattle in Riverton, Wyoming, and you always sell at the top of the barn, well, you can expect those prices on there. If you've got, cross cattle and they're uneven and they're not a full load, well, then that price you should expect less on it. Like I said, to finish the actual price, we use the feeder cattle index. For fat cattle, they use what's called the 5-area weekly direct slaughter, but they essentially work the same on there. It's actual cash prices. What I did here was just show, this is, I know you guys can't read this at all, but this is 1 day of the feeder cattle index. And so you've got all the different sale barns here, up the Midwest, Riverton's right here. But basically they take all the different weights there, divided by the total dollars, and they come up with this 7-day, it moves every single day, the index will change on there. But it's a quick snapshot of what the market's doing. And I did this one from I think it was January 17th. And the index was $1.79, and today we're at like $2.39, $2.40. So we're already 47, 48 cents higher than we were last year at this time, and then we're going to throw another 25 to 30 cents on top of this for you guys to put up on as a bottom on your cattle. So what I did, move that down a little bit. I guess it doesn't matter. You can kind of see it, but this is just a quick example here. We're pretending a 900-pound steer for, what is that, end of September 2024. So today, this was as of the 1st, but it's going to be pretty close to that. It ends at 273.50. I can generally get between that 99 and 100% of it, so I'm at 272 for my price. Let's just say the market stays exactly where we're at today, which never happens, but we don't go up, we don't go down, we just stay even until August there. 238 ends up being what it is. Again, I think it's 239 today, but pretty close on it. You just take your coverage price, the 272, minus that 238. That's a 34-cent pound on 900 pounds, or $306 a head payment on it, if the market stays exactly where we're at today. And so, I'd like to point out what's at risk there. Especially if you guys are buying calves right now and saying, okay, we can lock in $300 better market than we're at today when we're buying these calves. And this is really what I like to hammer on here. So this is, I don't know, it goes back to 2012. So we're at a 12-year showing the feeder cattle index every day on there. Obviously, you can see the previous high in 2014, that was 244. Those are the good old days, and then luckily enough, this last year, we actually reached a new high of 254. And so when I just try to reiterate where we're at in the market, obviously you can see all the ups and downs. Here's the big down, nobody likes that. Here's the big rise, here's what everybody likes. But when we talk about where we're at for next year, I can't even get it on my damn graph. So we're at 254 was the high in September of last year. We're at 274 way up here. That's your bottom dollar. If it gets to that, say the market blows by it and it gets to 284, you're out your 10 cents a pound premium, and you still get to ride the whole way up on there. So, a lot of guys, this whole last year, and rightfully so, people were protecting their risk, and so they were putting LRP on. It cost them the same 10 cents, but they still sold clear up here at the, 255 was in September, but October it came down to say 240. They paid the same premium, but still got to collect all the cash price that their cattle went up on there. So, too often, I think producers, we're all guilty of it. We want, everybody wants to hit the high. Well, how often do we really hit the high on there? What we want to protect is what's at risk. And I'd say on a calf, Robbie and Julie, you probably know as good as anybody on there. But what's a break even for a calf out here in Wyoming? Put you on the spot here. $900, $1,000, anybody?
Variable cost, everything included, you're probably $1,000 per year.
Okay, so if we look at what we can do for next fall, I've got no problem saying we're like at an $1,800 net bottom. Take the premium out, that's steers and heifers, $1,800. So say, easy figuring on there, you got $800 that you can put in your back pocket right now. Don't try and guess the high on it. $800 is a lot of money. There's 5 years ago, I bet we were selling calves for $850, $900. I know that wasn't very far ago. So I guarantee you were losing money there. Now we can guarantee a net profit of $800. That's a deal I'd make every time. In fact, I say that anybody gamble in here, go to Deadwood. If you can go to Deadwood and say, guaranteed the most I've ever made, I don't care what the premium is. I'll pay that because I'm going to make the most I've ever made. And that's where we're at right now. Now, so this example I just gave back here, this is on a 9-weight steer. So everything predicates off the Chicago Board of Trade. Chicago Board of Trade, like that price is kind of on an 850-pound steer. I say in the north, we kind of get a premium for our cattle, so I say it's like an 850 to 900-pound steer. And same thing with feeder cattle index. That's taking everything from 700 to 900 pounds, but really we get a premium on our cattle because we're in the north. It's around 850 to 900 pounds on it. So on calves, all they do is for steers under like up to 600 pounds on there, you just take 110% of that, but then you have to use 110% of the feeder cattle index. Same thing with the heifers, you just use 100% of the Board of Trade for 600-pound heifers, and then 100% of the feeder cattle index on there. So basically, if there's a loss on steers, there's going to be a similar loss on heifers on there. It's just a little smaller range because the total dollars at risk out there, it's a percentage, so it's going to be ratioed. Okay, so insurance in and on the end date. This is kind of the one part where people get a little bit nervous with LRP. Is we got to own them at least 60 days prior. So guys, always get worried about droughts in the summertime. The way it works now, the way it's worked since I've been selling it is, if there's a drought pretty much anywhere in the United States, they'll lift the ownership requirement on there. However, if I set my date for August 15th and I still have to sell them in June 15th because we're in a terrible drought on there, you'll have to sell them there. They'll still let you keep your insurance on, but you get paid on what happens on August 15th on there. So if the market goes down, great, you sold in cash, you don't have that extra gas expense onto it, and you get a big payment in your pocket. But if it goes up, you didn't get a rise that cash market on there. So that's kind of the one thing that's a little bit iffy on there. But other than that, you need to own the calves at least 60 days prior to the contract date. Like I said, I can write it when the markets are closes at 3 o'clock, and I have to have them in and uploaded by 7 in the morning, 7:25 the next day. As I talked about, what I like about it, as opposed to using the board for like a hedge, is you've got unlimited upside potential on it. You know, I worked with a guy in December where he was debating whether he should use a hedge or use LRP, and he said, oh boy, the cost of LRP, which is 10 cents a pound, is really not that much. He said, I'm comfortable with where I'm at with the board. Well, since then, he's paid, that was at 242, so he's paid 30 cents a pound on margin calls for the last couple of weeks on there. And so that starts to be on a lot of contracts too. So we're talking $700,000 in margin calls he's been making, where he's missed the total upside here. And on this, you've been out your 10 cents and you still got it. Target weight, just kind of a general area where you want to put them at. It's really kind of a gray area, it doesn't matter much. The unborn calves, that's instead of doing 100% for heifers and 110% for steers, they just ratio it and say 105%, and then you got your same dollars of coverage out there. You're just not really worried about having 60 steers and 40 heifers on there. You're just saying, I'm going to cover them all. Here's the total dollars coverage on it. And what's really nice right now with insurance being, or interest being as expensive as it is it's actually due 30 days after the contract expires. So same thing, September 15th, that's your endorsement date. It goes to the end of the month, September 30th, and then a month after that. So it wouldn't be due till October 30th. Which is really nice. I tell guys all the time, like, if you're paying premium, you got a fat check in your pocket, it's really not going to be that big of a deal for you. Although nobody still likes paying premium on there, but you'll have plenty to cover it, I can tell you that. So what I'd like to do here is just show the difference in the ratios between steers and heifers. This is the example. This top one here is basically that example I did earlier where I showed the $306 head payment on there. So heifers, they get 90% of this. It's supposed to be 272. We got a typo there. 272 on that, so that's the 245. But then they get to use 90% of the index, which is 238, and so that equates out to 214. So instead of a 34-cent a pound payment, they get a 31-cent a pound payment on there. On spay heifers, I like to bump the pounds up on spay heifers just because they generally equate out to basically what steers are bringing, or maybe a little bit less on there. So I'll raise the weight on heifers just to make that total dollars a head kind of the same thing on there. But a lot of times what happens is guys look at this heifer price and they say 245. Geez, that's not near as good as the steer price. Well, it all predicates off the steer price anyways on there. And the higher these prices get, obviously when you're doing ratios on there, the wider that gap's getting. So a guy wants to compare the feeder cattle index with what his actual cattle are, knowing full well that the gap's not going to be that big on there. You're still going to get your good cash price. So, like I said, what really did it for me is really believing that the feeder cattle index is representative of what the cattle market is actually doing, and it is. It's very accurate. What I did here, and I know this isn't necessarily where you guys are from, but this is for Phillip, South Dakota. This is in the middle of South Dakota there, one of our hotter sale barns on there, and I just like to show that 9/11 of last year, the feeder cattle index was at 250. Remember, the high was at 254 just a couple weeks later, but on this day, it was 250. So that's basically saying an 850 pound or 800 pound steer should be 250. Well, if you look at what our cattle do in the north, here's a 900 pound animal and it's bringing 251. So you're getting an extra 100 pounds, plus you still got a better price. Same thing here, an 837, 812, they're 10 cents higher, 16 cents higher. So just understanding that premium we get for our cattle in the north, especially if you're selling load lots, you'll make up that cash. That cash price will be better even than like the price when I'm quoting you, what it actually is. I always tell guys that the quote I give you for guys up here, I say is very, very conservative for what you should actually expect to receive on your cash price. Same thing with down here with heifers, Here you got an 880 pound black white faced heifer and she's bringing 239. Well, clearly that gap is different than that 850. It's only 11 cents on there, plus she put on the 80 pounds on there too. So, and it's no different with calves. Calves, you actually see an even bigger spread for us in the north here. If you look at these, 261 is saying what the feeder cattle index should be on a 600-pound steer. Well, now there's not a lot of 600-pounders here, but these guys 589 and they brought 297. Well, that's 36 cents higher than what they're saying that feeder cattle index should actually be on there. And you could look at all these light cattle. These light cattle, obviously 371 on 385. It just gives you confidence knowing that, okay, our market, whatever I'm telling you for LRP, our market is generally going to be a lot better on that. Now that being said, I don't know, does anybody sell cattle here in Riverton? I have noticed Riverton is a little bit off compared to Belfouche, Torrington, Phillip, Fort Pierre, those. It maybe not as high as these prices are, but that goes back to like, we're insuring the market. You still want to market your calves at the highest price possible. So financially it makes you sense to truck them to Belfouche or to sell them on Superior or sell them off the place. We still want to get the highest price possible on there. This is fed cattle, we don't really need to worry about that. Now this is kind of just looking at the next year. I'm sure a lot of you guys have seen the cattle on, not the cattle on feed, but the cattle inventory number. This was last year at this time. You can see just the liquidation of cattle we had through the entire Midwest here, Oklahoma specifically losing 11.5%. But basically the entire, every area I'm telling you that we're measuring these cattle dropped last year. And so that kind of started the run of the market. And then what we had happen last week, well, pretty much the same thing happened. They dropped again on there. And we were all pretty confident. I guess Oklahoma went up a little bit, but they're still down net negative 11 or 7%. We were pretty confident this was going to happen because, you know, that cattle on feed that kind of caused that drop on the fall. The cattle on feed, the heifer placement was way higher. It was record highs and everything. And we just thought, more heifers were going to retain to go into the bred heifer program on there. So when those numbers started coming out and saying, well, if that's true, then we're still not rebuilding our cow herd. In fact, it's still shrinking on there. And then on top of that, we had record numbers on open cattle from Montana, Wyoming over here, of open cattle going to slaughter. So again, we shrunk that cow herd on there. And the nearest figure I read today, actually, that this is just keeping your back of mind when you're getting these heifers on feed reports on there, but if anything below 36%, so you got 36% here, if that number is below that, the heifers on feed, that means the cattle herd will eventually start expanding. If it's above that, it means we're still contracting. If it's at 36%, then we're pretty much kind of staying the same. So we're 2 years of shrinking already, and we're still at 40% of heifers on feed on there. So we haven't even began to keep the heifers to start replacing those 2 years of shrinking herds on there. So that's reason number one. I'm super bullish on the cattle market on there. That being said, we've got record high prices. Don't let those prices get away. But let's just, like, I don't want to seem like I'm trying to do a scare tactic here of people like put the pressure on, you know, get this bought while you can. I'm bullish on the cattle market, but for other reasons, there's so much more uncertainty on there. I actually left this slide. This is from last year. It was 22 and 23, and it's comical to me because we can look at all these same things and say, well, they're still at play. They're going to be at play every single year. We have no idea when we're going to have heifer retention come in there, or another war come in there, or inflation takes off, or the dollar gets stronger. Those are not going to change. And so when a guy's making those decisions, you got to look at your own operation and say, okay, what can I change about any of this? I don't have any kind of control over any of these things here. What can I change to make my operation profitable? Okay, I've got the bird in the hand right here, and it's a big ass bird of money that you can take in right now. Take the bird in the hand, forget the bird in the bush. Because all these things we don't have any control about, and specifically we got an election coming up this year too, so who knows what that's going to do too. And like I said, this, you know, people get worried about the cost. You know, 10 cents a pound, 11 cents a pound is going to be kind of what it's at on there. I would argue with anybody that, I mean, I don't know, you guys, you got your bull costs, your vaccine costs, your mineral costs, your feed costs, any variable costs on their land costs, whatever. You can spend the most on all of that, but if you don't have a market price, you're going to be losing money on there. So I would argue that the 10 cents you spend on this is the most important expense you can to actually guarantee yourself a net profit on there. And so that's, you know, one of my final thoughts on there is don't be a victim. Last year, I say 10 cents. Last year, it dropped 10 cents in one day. And I don't know if any of you guys sell calves in the fall, but we do, and we sat there and watched it day after Thanksgiving fall 10 cents. And then luckily we had LRP, so I wasn't too worried about it. But I took a lot of calls of guys of saying, you know, geez, this market, and they're blaming LRP and this and that. And I finally had to come back to them and say, well, did you have the opportunity to collect that 30 cents? And it gets quiet on the phone every time, and it's like, well, yeah, but if this wouldn't have happened, well, was it greed that caused this, or was it you didn't take advantage of what was presented to you? And that's kind of a hard pill to swallow, but we all got to look ourselves in the mirror on it. And like I said earlier, don't be scared of missing out on the high. If I'm paying premium, that means that the market's gone to the moon right now, and we're going to sell the highest calves by a long shot, because I've already built in to 10 cents over the highest market we've ever had after the premium's taken out. So if I'm paying premium, I hope it goes to $3 on there on the feeder index. That's good for me. And it means that next year I can already start locking in calves for even higher price on there. And that's my goal on any risk management, whether they're using the board or hedging or whatever on there, is let me make it 1 year farther than everyone else, because when everyone else takes it in the shorts, then I'll have that cash and be ready to make an opportunity when it presents itself. I'll talk about corporate wall here in just a hot second, but one of the points he brought up that I thought was a very good point was the feeder board. And I never realized how fickle it was compared to our other energy or our other stuff that trades on the boards there. But you can see corn here, 128,000, even fat cattle's at 10,000, but feeders only 2,200, which can be good and bad. A ripple can cause a huge wave, and everybody loves it when that wave is sending it up like this, but nobody likes it when we drop one in there and it causes it to drop by 30 cents. So the key is to take advantage of when that ripple causes a positive wave, so when the negative wave happens, that we're protected on there. I can't, like oil, you know, you look at oil and other energies on there, and they're like hundreds of thousands, kind of like corn on there. So just understanding that the feeder, if it doesn't matter what happens, the feeder board takes a beating on it, and you can just about guarantee that's going to happen. This is just showing that it's not a fly-by-night deal here, that there's been a lot of success with it, that people are happy with it, but this is back in 2020. LRP represents the red right there. I don't even know how many that is. It's next to nothing. Obviously, we started seeing growth here, really here, and 24 is going to be enormous on there. So you can look, that's $15 billion in liability that's been added in the last 3 or 4 years. One reason I like to highlight that is part of the reason the cash market stayed so strong this fall when the feeder board dropped 30%, is there were so many of those producers that had LRP on that said, well, I lost that 30 cents in the slide, but I didn't really lose that slide, so that's still in my back pocket, so I can still come to the sale barn and I can still bid what I want on your calves and make it through to the next year on there. And LRP, I've got no doubt. I mean, you can put these two graphs beside each other from 21 to this, 21 to now, and show the rise, and I believe that's a pretty well direct correlation of LRP on top of that. Anybody get into feeder flash or corporate wall or have to hear those questions this year? He was blaming a lot of stuff on LRP. I just like to point out corporate wall. I think he's good for the industry on there. He's no different than Fox or CNN, though, that he's got to have an opinion every single day. And it's also no different that clickbait is real, and they've got to get what they get attention for. And so when the market was going down, he was kind of bad-mouthing it and saying that people were taking advantage of it and putting all this money, and basically the funds all pulled out to cover themselves. All of our research at Farm Credit does not show that that's what happened, and basically it's just the funds were saying, okay, we're way long on all this stuff, we do have to get out of it, which happens every other time too, but I don't know why LRP was whipping boy this time. But anyways, he kind of ragged on it for a while, and then now all of a sudden January he's changed his tune, and now he's like, yeah, you got to have LRP. If you got feeder cattle, you got to be an LRP. So just understand that, you know, he's got good points and bad points, but we just really need to investigate what he's saying sometimes instead of just taking it as gospel. One thing he did bring up though was this harvesting the subsidy, and that was happening. You know, back in 2020 there, when I first started selling it, it was a 2,000 head limit, so it was truly for like us smaller producers on there. They've jumped that up to about 25,000 head. So it basically what they do is they buy a LRP contract, and then they'll sell a put against it, and then harvest the subsidy on there. So if I buy LRP for 6 and I sell a put for 9, if the market goes down, I collect that 3 cents, and at 25,000 head at 1,000 pounds a pop, that ends up being some serious money they're getting. RMA has been able to, they've now worked with the board basically to see, they can track if somebody goes and writes 10,000 head for March 4th, they can see if somebody buys that much on the board too. So I do think we'll start seeing that lessen. And it's just one of those things with any crop insurance, it's only as good, or with carbon on there, it's only as good as the validity of it. And so we want LRP, we don't want these guys trying to take advantage of it, because all that happens is we end up losing a good product that actually helps us make money. Anybody superior sales in here? Let's say a little more of that. Superior sales or private sales. The one thing, the question I get a lot on it is, if I set my price in August or July, do I put my endorsement for July, August, or do I put it for when I deliver in October? And my answer for that is, if you're absolutely going to take that price in July or August, then that's when you should put your endorsement on there, because that's where the actual market discovery is at. If you say, okay, I don't have to take that price, I'll no sale them, or I'll just wait till the fall, you've already got a bottom set for October, November. So if you're willing to do that, then I put it for October, November, because you've already got a bottom set on it. You just see if the cash market catches up to it. Wean calf protection, well, the first bullet point kind of says that juice isn't worth the squeeze, in my opinion. It's a pilot program. FSA just pushed it out here a couple months ago, and they blasted it everywhere. It's like everybody should be looking at this, and it's trying to mirror crop insurance as far as like corn production, and you have a APH, so you have a 10-year history about your calves' weight, and you got a calf reporting day. You got 2 or 3 of those, and then there's a lot moving on to it, and I really have not found one occasion where I'd say it's a benefit over LRP, where I would use it over LRP. So certainly if you guys do have more questions on it, we can get into them, but the biggest thing is you can only get, the highest coverage you can get is 85%, so you have to have a 15% either death loss or loss of weight before you start getting paid. Well, 15% loss of weight is pretty dang hard to do, and you're not going to get anything paid until you hit 60%, so it's just not quite worth it in my opinion. All right, I've boogied right on through that. What do we have for time here? 11:30. All right, what do we have for questions out here? I'm gonna start calling on people. I got no shame in that. What's your operation?
I sell insurance.
You sell insurance? Good.
So I'm actually really curious because I don't know anything about this livestock protection stuff.
Yep.
I'm on the property casualty side.
Right. Well, but you can understand from the point of like protecting what's all at risk out there. I mean, if you look at it's bananas to me that people would go out there and buy 5,000 head of yearlings and not have any coverage on them, and just hope that all is good, and not realize how many millions of dollars you've got at risk out there. And for years, that's what we've been taught to do. Well, just tighten your bootstraps, and hopefully things get better on there. And the other thing with what I'll say with like property casualty on there is nobody with a premium. I think we get cattle producers out here, and nobody wants to pay a premium on there, but it's like, you've got your vehicle, you don't hope you go wreck that, or you don't hope your house burns down so you don't have to pay a premium. You pay your premium every year so you prevent those wrecks. So I think it's like any other insurance on there. The difference between just this crop insurance in general on there, but so do you know what your actuarials are for, like, say, a house insurance? You know what the rate is?
We've got a decent idea.
Okay, so I don't know, I've heard anyways from like $1.30 to 1 or $1.40 to 1, depending on what it is. So for every $1.30 you put in, that's how the company makes profit, right? Then you get $1 back, that 30 cents is profit, is how I understand it. Crop insurance is written at 1 to 1. By federal law, any crop insurance, multi-peril crop insurance has to be written at, for every $1 you put in, you get $1 back. However, for every $1 you put in, the government's paying up to 55% of that dollar, but you get to keep the whole dollar you get back. So crop insurance is actuarially written to make the producers money on that, and that's corn, beans, LRP, anything on there. That is where crop insurance, your 101 list on that is you should always be looking to maximize the subsidy on there, because that's the government basically paying your portion of the bill that you'll eventually get back because it's written at 1 to 1. We got any producers in here? About the back there in the back. What kind of cattle do you raise?
Got 7 acres.
When do you sell them at?
Well, are you talking weight wise?
Well, when and weight.
Yeah, it's usually October, end of October, so a little later than miss that first surge.
Yep.
And then the one red flag I had on that, you're average like 7 to 9 on
Mhm.
the weight. We're not getting that.
Yep.
You know, we're getting maybe 650.
Yep.
And so just kind of seeing how that incorporates.
Sure, so this is gonna be kind of right, that October 30th day, you know, we're gonna be kind of around there, right?
Yeah.
So, totally agree with you on there, and that, so that's 700 to 900 pounds down there, again, that's like an 800 to 850. Well, to get the calf price, they take it times 1.1, and they do the same thing with the feeder cattle index on there. So, if I say the feeder cattle index on this date is 237, I take it times the 110% to say this is my bottom, and this was last year, but they're saying, okay, this is 261. Well, look how much higher these prices are than that 261. And so what a guy wants to do is say, okay, I sold last year on October 21st. Let me go to the feeder cattle index on October 21st and see relative to where my cattle sold on there. If you're doing Sim Angus, if they're load lots on there, like you're gonna be way, way above that. And so that's why I say it's a very conservative price of what I'm telling you on there. Because this price that I'm telling you is, you know, that's including Texas, Oklahoma, like all those cattle. They're saying that, the average is gonna be around there. Our cattle bring so much more, or just bring so much more less. We're gonna be getting this actual cash price up there. And so literally, like, when this really turned it on for me is I took our actual cash sales and compared it with the feeder cattle index to see how much higher we were actually insuring on there.
And then if we sell early, then you still paid out on that day.
Yeah, you wanna sell as close to that date as possible. That's like your most accurate insurance, because that's what the market is doing on October 30th there. And you can, I mean, you never have to sell them either. That's another situation we've gotten into is, say you have that black swan event happen, and you get there, the market just tanks 3-4 weeks before you sell, and you say, well, I'm not just gonna give these away, I've got the feed or whatever. You'll get your insurance payment, and then if you had the feed or the capability, you could actually do a new contract for, say, March or April. Say, I'm gonna background these clear until March, put a new bottom on them and say, like, I think this thing's gonna come out of it, and if it doesn't, well, I already paid my insurance premium on there, and I've set a new floor too. So in fact, I got a lot of people that do the unborn calves to the weight 1, to the weight 2, to the fat cattle on there too. And the whole idea is just like, let me stair step that risk on there, instead of just not having anything, or just shooting everything for the fat cattle right off the bat, if you're doing like unborn cattle.
You just, I know that you already have it, can you go through how the premium is set again?
So, that's a good question, actually. I should have a slide on that. So basically, it depends on how many trades happen. I didn't have that, I'll just hop through it, but, so, like at the end of the 2024, or 2023, when we got so volatile, then that just makes the premium go up, which stinks because the price was going down the whole time the premium was going up. But it was also because there wasn't a lot of trades happening, because everybody was kind of waiting back. Those nearby months were trading a whole bunch, and so that was causing the out months to move, but nobody was actually trading them. There was nobody buying and selling them. And so now that we've got more of those months trading, the premium will start coming down. And so, like, what is it, February? If the closer you get to your endorsement date before putting it on, it'll cheapen up. So if you wait till June and the market keeps going up on there, you got the chance that you'll get a higher price and a lower premium. The risk is that it goes the other way on there, and that the market tanks and you still got a high premium. So, like I said, it kind of, right now if you're in those fall months, it's like 10 or 11 cents a pound on there. If you start looking at May, it's gonna be 6 cents a pound probably, just somewhere in the middle of it. What is weird is, like, when I first started selling this, I remember selling it and saying, okay, we can have $1,000 average calves, and that was like, oh yeah, we'll take that every day. And the premium was like 6 or 7 cents. Well, now we're up to $1,800 calves, and we're at like 9 or 10 cents a pound on it. So it seems like even though that net profit we're protecting is growing so much, we're really not paying that much more in conjunction with the way as much as it's risen on there.
How far out do you have to buy?
You can do, you're supposed to be able to do up to 52 weeks. So it should be able to go to a year out, but it all depends on if it's trading. So right now, January's getting to have more trades in there. I'll have a January price here for 2025, probably in the next week or two sometime. And even sometimes I'll have a January price, and for whatever reason, November didn't trade that much that day, but so I won't have a November contract, but then the next day I'll have a November contract on there. It changes every single day on it. And we're working on our website, on our farm credit website, where we have that information available, where a guy can go look it up. Otherwise, if you just call me or give you a holler. I mean, the easiest way to do it is just listen to the board, whether it's on AM radio or hop on Cadillacs. You can see what it's at, and you can say, oh, for calves, you can just take that number times 110%, and that's about where we're at. Like, if I do it today, it's showing, I think it's October, November's like right at $3 for a 6-weight calf. And so, okay, that's an $1,800 calf. You're saying, well, you said that's for a steer. Heifers are gonna be light, but consider the cash premium we're gonna get for our cattle. The actual numbers we're insuring is probably an $1,800 calf on that. Robbie, Julie, anything to add there?
Well, I guess, I thought you would get them emailed out so if I were to sign up.
Oh, you can sign up for
Then
it.
they don't email it out to you if I sign up.
Like
I do,
the daily quote?
Yeah,
You can. It's like basically you have to, I guess I should be doing that, but like basically if you sign an application with us, we can sign you up to get a daily email on there. It's kind of if you want an extra daily email on there or not, or you just know the quick and easy way to figure it. It's just watching that board and knowing what it's kind of going to cost on it. To Rob, well, to both of their facts too. So like say you're going into, say you're gonna go buy 200 head of cattle. Like if you can go to your lender and say, I've got $1,800 calves. It used to be you go to FSA or Farm Credit or whatever, fill out a cash flow and say like, hey, this is what I think calves are gonna bring. This is kind of what they're bringing right now. Well, that's complete random. It's like you have no idea. Whereas now you can go in there and say, I've got $1,800 calves coming. And then I go through all my, other projections on there and I show a net profit of $600 or $700 a head on there. And that's pretty well taken. I mean, literally take it to the bank. And it's in your pocket on there. Conversely, if you haven't bought those cows yet and you're saying, oh boy, this grass just came up over here and it's $45 an AUM, or I don't even know what it would be expensive over here, but $45 an AUM, but you got an $1,800 calf you can pull off of it. You can say, well, heck, I'm gonna go buy red cows at the sale barn for $2,200. I guarantee myself an $1,800 calf off that, and I'll have $400 left over, and I could just kill the cow, not even breed her, and still make money on that. So it's just figuring out how to use it as a tool. Same thing with bred heifers. You can go buy a $2,000 replacement heifer right now. That's whatever, 700 pounds, and hope that you can make enough money on your bred heifers, or put some LRP on it to guarantee the market that you're going to be selling it. Actually.
So I would add in there, I work with a lot of young beginning farming ranchers. We're all guilty of this. I don't care if it's political, whatever. We listen to the daily trades, we listen to the things out there, and we start to buy into whatever the hype is today. Either the cattle market's falling tomorrow and we're all gonna lose everything we got, or it's gonna go higher than it ever has before, hang on to everything. And we get caught up in all that conversation, and we come up to analysis paralysis. We don't do anything. Well, what I will tell you is it's even going back to that 14 market, we're in a different place. Land costs are higher than they've ever been. Interest costs are higher than they've ever been. Your goal as a producer, let's throw out all the other noise, what could happen, what might happen, and start to look at our break-evens and our real numbers and say, what will it take for me to operate? At 9% interest, if I can carry over more money next year, even though it may cost this year, don't look at everything as a single year. Can I borrow less money next year? Well, if I can do that, how much more money does it put in my pocket next year because of the decisions I made today? We can't live into where we're at today and base those decisions on, I just want to catch the highest part of the market and have this most money in my pocket.
Right.
That's not a forever solution.
And it's funny to bring that up on there too, because that's on any ag economist or whatever on there, they've always just say, Cadillacs is the perfect example I always bring. Like they always just say exactly what's happening right now, and we expect that to keep happening. And it's like, boy, way to step out on a limb there. And they did it. I mean, you look at December, like November, December, everybody's like, well, we knew this was coming, here comes the correction, and they all, and it's like, I want the guy that's like, no, February's gonna be awesome, but nobody ever does that. And so, drovers, they just put an article out yesterday, and it's like, oh, you guys haven't seen nothing yet, like, this market's really gonna take off. It's like, well, where was that 2 weeks ago? But now, since it's happened, now they just say it's gonna go to the moon. So, yes, with Robbie, I would say, be very careful on, as and agriculture in general, we're just overly optimistic when things are looking good, and then when things are bad, we're like, it'll come back. I don't know why we always think that way, but it's the way it is. So take the big sting out of it. You know, if here's your break even, here's your $1,800, just take that little profit on the top and guarantee all this, and then leave the upside completely open on it. That's LRP in a nutshell on there. And it is sleep at night coverage. Like, you just flat don't worry about the market after that. You might worry about, oh boy, I wish I would have waited to get a couple extra cents, but as far as being a producer next year, as far as making good money this year, you can just go ahead and take that worry away pretty much. Got any questions? Good.
I'm only in the equine industry, so whole different market.
Yeah, we can't insure those.
So you guys find out that insurance for them is
Yeah.
different but similar.
Right. That's the one thing I wish, like on that wean calf program that they have, the one good is there is some kind of mortality insurance on it. So what we're working with a couple different AIPs that we write with is saying, how can we add some mortality insurance on that? Because that's the big risk. I mean, I just said you sleep at night coverage, but after your calves are born and they're not in a storm or anything. And so how can we put that mortality pair with LRP to say, okay, we're gonna cover the calving period there for 60, 90 days, and maybe a drought clause in there too. So we're gonna constantly be enhancing the product on there just to make it better for producers on there.
So you're buying it, so how do you buy that out with the projection? You're buying or you're insuring the price of the market, no matter how many you're bringing to market, right?
Right, so you pick that number. So say you got 300 head on there, I'd just be conservative, say 90% calf crop on it, and kind of average what you think they're gonna weigh. I always bump the weight up just to further represent the premium we're getting for our cattle.
So my question earlier about like how far out you have to buy it, can you buy it in May through the end of the fall?
Yeah, you
And
can
be like, here's what our cap count is, and of course you have a mortality rate maybe over the summer, pasture and stuff, but then.
Yep. Yep, you can ride it anytime from 52 weeks, as long as I can go, up to 13 weeks out. So if you're in October there, it'd be like, September or something.
Yeah.
It's just you run the risk of the market going back down. So, I mean, I'm not saying come in and buy it there, whatever, it's a good time, don't get me wrong, but now you're armed with knowing where we're at, and knowing, okay, what am I actually talking dollars on there? If it starts to slide, 4 or 5 cents, and you think, oh, now we are going back the other way, just put the coverage on it. You'll be happy you did, even if you're paying your premium on there. Just know where you're at today, instead of like I said, instead of going to the bank and saying, boy, I sure hope we get $1,700 calves or $1,800 calves, just take that risk out of it. And it's very, even as a producer myself, it's been very beneficial, allowing me to be aggressive in the grass market, as I just don't worry about it. It's like, hey, that part's done, grass, yeah, I'm paying too much for it, but I've got it protected, so I don't really worry about it. And you can start improving your genetics on that on top of that.
So Julie and I work on the financing, and that's, I'd say this is a major piece of the puzzle. And to win to sale, that's where it comes down to really knowing those projections, what they look like, and grabbing that information on the flip side, so it's not just a shot in the dark, because, hey, I feel good about this today. We lock too many things in because it feels good when we go back to that height. But if we can lock that price and say, this is my break even, and this is the profit that I am happy with, we all want more money. That's easy in the cattle industry, we want more money. But this is what's gonna give me my break even. This is what's gonna make me feel a little bit better. This is what's gonna allow me to operate next year. That's when you potentially could lock in that price. Don't wait for it to, man, I hope it knocks it out of the park. Because as Rich said, you can still capture that upside all day long. You're setting your own protection because you have penciled out what that price can be.
Yeah, that's the key, is knowing what that break even is on
Yeah.
there. Because I'll get guys all the time, well, I can afford to take the risk. Why would you? That's like saying, well, I can afford to buy a brand new pickup, but so I don't carry insurance on it. It's like, well, it doesn't make any sense. It's not like a bragging right thing on there. It's just, why would you put that much risk out there when you can protect it? We've got the tools to actually protect it. And that is, I mean, most years I'd say $200 to $300 net profit, if you could guarantee that, like, that's a pretty dang good deal. You know, on a 300 head outfit, that's 90,000, that you're supposed to live off of that. And we're at 800 right now, double that, almost triple that. There's money to be made in agriculture, but you gotta take your opportunities when they present themselves, and they're presenting themselves right now. 2 minutes? I don't know if I can keep going, I don't got any more jokes.
Well, one thing I would, and to add to that, in our industry, one thing we truly have to focus on is working capital. And that's all coming off the top side of the balance sheet, and Julie's gonna talk about this tomorrow, just a shameless plug for her, to come in and listen to that. But building the working capital now, that is what gives you the cushion to carry you through the next downturn, whenever said is. In 4 or 5 years past that, hopefully we can start getting back to that.
Yeah, because eventually there is gonna be a point, yeah, where we're back to $1,100 cabs, and you're just gonna be like, oh, why did I not do that, yeah.
The basic definition of working capital is the ability to meet short-term debt without the interruption of your day-to-day operation. So you don't wanna have to sell the factories, which is your cows, in order to cover that debt. And the longer you can hold on to that, the more you can spread out that cost over years, using tools such as this, the more sustainable it's gonna be. Because then you can redefine the market and go back to buying cows at cheaper prices and still build in what that looks like.
Yeah, you got opportunity when it presents itself. For sure. Well, I thank you guys for your attention, and any questions, certainly give me a holler. Talk to one of these guys if you need my number. I got cards somewhere around here too, but enjoy your time. Thank you.